Hi, this is a quick introductory session on call options. So when we say someone or a firm holds a call option, what that basically means is that you have the option to purchase a particular underlying. So this can be an asset or some sort of a commodity or a financial instrument. It gives you the option to purchase the underlying asset at a fixed price, but not the obligation. So basically, the holder of a call option has the option but not obligated to purchase the underlying asset at a fixed price in the future. So here I'm showing you a diagram. So let's assume that you have entered into a call option. You have purchased a call option, and which means that you can purchase a particular asset, the underlying asset, at this particular price, which is called the strike price. So it's part of the contract. It's the fixed price that you can purchase a particular asset in the future. So let's assume the call option is on a particular stock. So the stock price, which is shown by this line here, the stock price has been volatile. It goes up and down, but it never reaches the strike price. So in this case, you will not exercise your option. If you think about it, why would you purchase a particular asset at a higher price when you can purchase the same asset at a lower price in the market? Because you can see the stock price is volatile, it goes up and down, but it never reaches the strike price. In other words, the price that is highlighted or mentioned in the call option contract. So because of that, you will not exercise or use the right as part of the option to purchase the asset at the strike price. So in this case, the call option is basically invaluable for you. So that's the reason we don't exercise. Now let's look at another scenario where you have entered into a call option. Basically, you have purchased a call option. So that's the strike price. And you can see the asset price is increasing and it has started to go beyond the strike price. And let's assume you're at this point. Let's assume these are European call options. In other words, remember, European options can be only exercised at maturity compared to American options. American options can be exercised anytime. So let's assume these are European options. Just makes it quite easy to understand. So let's assume at maturity, the stock price has gone beyond the strike price. Now in this case, you will exercise the call option because think about it, you can purchase the same asset at a lower price because of the option. If you don't have the option, you'll have to purchase this asset at the market price, which is very high. So you will exercise the option, which means you can purchase it at the strike price, K, and the difference between the strike price and the market price of the underlying stock, which is here, that's the value of the option. So you can see a call option is useful, especially if you're buying a call option. It's useful if you have an expectation or an anticipation the underlying will increase beyond the strike, because the call option is only valuable if the underlying goes beyond the strike. So that's in a nutshell, that's a high level introduction of a call option. So here I'm showing you the same example. So that's the strike price and that's the price of the stock. It goes up and down. If the stock price never reaches the strike price, then the call option is not valuable. So we call it out of money. Out of money means there is no value in the call option at that particular point in time. But if the stock price goes beyond the strike price, suddenly we call it in the money. In other words, the option has value. So you can see someone would purchase a call option when there's an anticipation or an expectation that the underlying has a chance of increasing beyond the strike. So that's what one of the motivations to purchase a call option. And if the call option has no value at that particular point in time, we call it out of money option. And if it has some sort of monetary value to that option at a particular point in time, we call it in the money. Because remember, in the money and out of the money is time specific. An option which is out of money can become in the money the next day or even within a day. And remember, out of money options are cheaper to purchase because the premium attached to an out of money option will be much less than buying an option which is at the money. In other words, at the money means there's no profit or loss. It's almost here. At the money option, or of course in the money option, means anytime you can exercise that option. So that's something to remember as well. Now finally, so I'm showing you here, if you take a long position in a call option, in other words, if you purchase a call option, how would the payoff look graphically? So here I'm showing you some strike price, the stock prices of the underlying. So $5, $6, $7, and $8. The strike price is $6, and you can see in the first two events you will not exercise the option because the strike price, the stock price is lower than the strike price. You can see in this instance you will not exercise because you can buy the stock at $5, and even at this instance, even if you exercise, the payoff will be, remember the payoff is always the difference between the stock price and the strike price, so there's no payoff. On the last two rows you will exercise the option because now your strike is lower than the stock price, so you will exercise and that will be your payoff. So the payoff of a call option is S minus K. In other words, the spot price minus the strike price. That's the payoff. So that's where you can see you have a positive payoff. And these are premiums. When you purchase an option, you always pay a premium, irrespective whether it's a call option or a put option. So these are the premiums and these are the profits. And based on that, I have drawn a diagram here. So you can see a call option, when you take a long position in a call option, it only becomes profitable once the underlying, so the x-axis is the underlying, which is the stock price, the underlying moves beyond the strike price. The underlying has to move beyond the strike price, it becomes profitable. Now here, the reason this line is not positive at $6 is because of the premium. You need to factor in the premium. So if I take off the premium, this line will start increasing from here because it will become profitable after $6. The reason even at $6 it's negative because of the premium, because I've included a premium here. So that's a long call. Now if I draw a short call, it will be the opposite direction. So it will be like that. The short call will be like that. It will be in the opposite direction, which is quite risky. You can see a long call, the biggest loss you can have is just your premium that you pay, because the worst case is you will not exercise your option, which means you have just paid a premium. So that's how you calculate the payoffs. So remember, an option gives you the option to purchase asset, in this case a call option, but not the obligation. And one of the motivations to use a call option is an expectation that the underlying will increase in price. Thank you.